For the sake of ensuring that we've got the maximum bandwidth, I will mute my side of the video, but I am going to share some slides with you just now. Okay, I'll just request my host a little bit to enable the screen sharing. I want to share a slide with you.
You should be able to share your slides now, Bonakele.
All right, thank you very much. Please indicate to me if now you can see my slide.
Yes, we can.
All right, good morning, everyone, once again. We're going to go over our class on, can everyone please switch off their videos? I can see some of us. And so we're going to go through the correction of errors. Now, the correction of errors have three categories that we're going to explain today and go through. The first category is what happens in a situation where you have errors that have occurred in the current period. And the second category will be what happens when you have a prior year period error, but that error is immaterial. And we said that if an error becomes immaterial, we'll, at this stage, provide you signals on whether it is material or immaterial. But what we need to understand is how do we adjust for errors if they are immaterial? And then the third category will be prior period errors that are material. And now these are the types of errors that are covered in the standard that we started last week, which is IAS8. So it covers three categories. Now, if we can recall from the previous time, there was an emphasis that we made on changes in estimates. And I would like some brief interaction to recall what was the key principle that we highlighted on changes in estimate. I'm just going to scroll down the people, and if someone can just reflect, specifically, what did we say about changes in estimate? Where, in which accounting period do we adjust changes in estimates? Okay, if specifically is still thinking about the answer, you can just shoot through if you think you have an answer for my question. Any of you? Are the people still remember which period we said we could adjust prior estimates? I mean changes in estimates. All right. Yes. Yes. Or I thought someone was giving an input. Okay, we only adjust changes in estimates, obviously, in the current period that we're accounting for moving forward, right? Because they are not an error, but they are just a change in how we view utility, how we view how we're going to consume, for instance, an asset. We said an asset is consumed through depreciation. That's how we account for the systemic consumption of the asset. So we use depreciation. But if there's a change in that, or there's a change in the residual value, we only make those adjustments from the current period to the future periods. The case of error is different. When there's an error, it may be there is an instance where it can be adjusted in the year in which it has occurred. So we said that there's three categories. The first one is there would be errors that are only adjusted in the current period because they are current period errors, and there are errors which are material but they occurred in the prior period, and we want to demonstrate how we account for that. And then there are errors that are material, and if they are material, they have to be adjusted in the period in which they occurred. Now, let's start with category one of the errors. Now, category one of the errors deals with the current period error. So, which means an error that has occurred in our current period. How do we adjust for that kind of error? So, a current period error, it's an error that has been discovered in the current year, but also it was occurred in the current year. So, we find an error that has occurred in the current year, And also, I mean, we discover it in the current year, but also it has occurred in the current year. Now, what is the accounting process for that? So you correct the error, obviously, in the current year. And there's no need for disclosure. Why there's no need for disclosure? We'll show that in a form of an example, because we found this error in the current year and we've now made an adjustment in the current year. So there's no need for disclosure, but let's do it by the way of an example. So our example is example 7. Now the company purchases a vehicle in this example on 1st January 2019. And now the vehicle that was purchased on this date was depreciated, and its depreciation was 10,000. But this depreciation was erroneously debited to vehicle. In other words, the vehicle had increased by 10,000. It was increased by 10,000. Remember how depreciation affects an asset. Who can sponsor me with an answer on how depreciation affects an asset?
It decreased the asset.
So depreciation decreased the asset. And why does depreciation decrease the asset? Who can also tell me why does depreciation decrease the asset? So first of all, depreciation is a form of an expense, isn't it?
Yes, it is.
Yes. So which means if it's an expense, it's got what balance? It's got a?
It doesn't have a balance.
It's got a what?
It doesn't have a balance, but it's debited.
It's debited. As an element, it affects the financial statements on the debit side, but it does not have a balance. But can you see how that can easily be an error if you go add it on the balance of an asset, because it's got a debit balance. So it might be a typical error that can occur. Now, given that they've made that error, we need to reverse it. So this error, first of all, it has occurred during the financial period, which is 2019. And it's also discovered in 2019. But also now we're told another information. We're told that wear and tear. What is wear and tear?
Wear and tear is what SARS take depreciation as in their side.
Yeah, so it is wear and tear is a form of how SARS will depreciate the same asset, right? So we use depreciation to indicate how this asset over time loses its value, but on SARS they have a wear and tear system. So according to this information, wear and tear of 4,000 was correct. So the treatment was done correctly from a tax perspective, but it was erroneously done from an accounting perspective, right? And also we're told that the tax rate is 30%. Now, here's the question. Generalize the correction of error. Now, how do we generalize the correction of error? We what? So if the error was 10,000 and this 10,000 was taken as a debit to vehicle, as you see below, the incorrect journal, and accumulated depreciation was then credited correctly. How do we do then the new journal that represent the correction of error?
We
So
credit
all
the asset.
indicate to me if you can see my slides as I'm typing.
We can see it.
You can see it. So you can also just on the comments, just if you can see, just say sharp. If you cannot hear me, you can add a no, but you can all see it now. Is it visible now? Now, what do we, in correcting this error debit, what should have been the correct account? It would have been depreciation. Now indicate which element does it affect?
Expense.
So we have an E for an expense, indicating that this element, affects an expense. And how much do we put on the debit?
10,000.
It's 10,000. Now, because this is a correction of error, what do we credit?
Asset,
The asset. Why do we credit this asset?
because the accumulated depreciation was done correct. The only thing that was mistaken, it was the asset increased.
So we all agree. And now how do we write a narration to this journal? Now it's correction of a journal dated 2019. So we're correcting a journal that has occurred in the current year. So hopefully we've all seen the journal. I'm going to delete it now because I need more space to indicate another principle that I wanted to touch on. Now, the second aspect of this question that I wanted us to deal with, now we've seen how we can correct an error in this journal in the instance where the error has occurred in the current year. Now, I want also to do some calculations of proofing. What we want to show proof for is that the taxation has been correctly treated. Now, to do that proof, we have an incorrect and a correct scenario. Because suppose both accounting and tax had been incorrectly treated, this would have affected how we reverse and show the accounting for this journal. But now we want to first of all show you a proof of the current tax calculation, why it's not affected if ever it's been taken into account correctly. So let's assume a profit figure. Let's assume we had a profit in the current year of 200,000. So we write both on the correct column and the incorrect column, the 200,000. Now, this profit would have been affected by depreciation if the depreciation journal was correct. So it would have been less depreciation. But we know that we did not, because of the incorrect journal, adjusted for depreciation. So under the incorrect column, the depreciation is 0, but under the correct column, which is what should have been done, we would have deducted 10,000 on the depreciation. And therefore, the profit before tax would have been 190,000. Instead, the profit before tax in the current year is how much? It's 200,000. Can you indicate that you're still with me by saying yes?
Yes.
All right. Hopefully, everyone is still here. So, in calculating your current tax calculation, you would have first added back depreciation. In this instance, there was no depreciation you would have added back because it had not been adjusted for correctly. But here you would have added back 10,000. And now essentially you would have had 200,000. 200,000. And after that, you would have, after adding depreciation, you would have less wear and tear, which is the allowance from the revenue services from the fiscus of 4,000 on both sides. 4,000 and 4,000. So ultimately, how much would you have had at the end? You would have had 196,000 and 196,000 from which you are going to use to calculate your current income tax. So your current income tax on both sides would have been based on 196,000. What I wanted to show is that this depreciation that you see here would have essentially been added back, and then you would have deducted wear and tear. But since under the incorrect journal, there was no such depreciation, you would have not added back the depreciation at all. Rather, because it wasn't taken care of, rather you would have deducted the 4,000. Now, you see the tax implication. But the 10,000 on our initial journal was also now, if you put the 10,000 on the initial journal as an expense, would that not have an impact on our tax calculation for our deferred taxation? Who can give us the answer?
So you made a mistake there.
Where?
On the correct side.
By? Oh, by what?
The total profit before tax supposed to be 210.
The total profit before tax is supposed to be? So profit before tax, remember, so I said this is an assumed profit before tax. So it was 200,000 on each side, right? But what I'm saying, had that profit before tax been correctly counted, right? You would have deducted 10,000 of depreciation. Do you agree with me?
Yeah.
Now, if you would have deducted 10,000, you would have ended up having a profit before tax of how much? Of 190,000. You agree with me?
Yes.
Now, remember, there is a timing difference between SARS and our own way of depreciation. So wear and tear does not always necessarily uses the same method as the company does. Hence, now we have differences, right? The timing differences. And the timing differences is what we essentially call temporary differences, right? You're familiar with the term temporary differences?
Yes.
Now, we need to then add back how we depreciate an asset. Hence, we added back the 10,000. Do you agree that we needed to add back the 10,000?
Yes.
You all agree that we needed to add back the 10,000. Hence, now we ultimately have 200,000. Do you understand why I have 200,000 here?
I understand.
You understand now, or are you still disagreeing with me?
I understand now.
Okay, we're on the same page. But here, because on the incorrect side, we're just indicating what had occurred. What had occurred on the incorrect side is that they did not take into account the effect of the depreciation correctly, right? Now, the second question is, we need to do a deferred tax calculation. Now, I'm going to delete all of this in order for me to do a deferred tax calculation. Now, when I'm doing a deferred tax calculation, what do I have? CA stands for what? The carrying amount, right? And TB would stand for what?
Tax base.
The tax base. And TD would stand for what?
Temporary difference.
And DT would stand for what?
Deferred tax.
Deferred tax. And we're trying to calculate the deferred tax. Now, let's start with showing our incorrect balances. So what had been the carrying amount of the asset on this date? What would have been the carrying amount of the asset on this date?
$100,000.
It would have been, hello? It would have been 100,000, right?
Yes.
And then what would have been its tax base?
And 96,000.
96,000 would have been the tax base of the asset. And now this is based on the incorrect where the 10,000 had not been taken into account, right? And now what would have been the temporary difference? 100,000 minus 96,000, it would have been 4,000. And what would have been the liability? So 4,000 multiplied by 30%,
1.2.
it would have been, sorry, 1,200. And that 1,200, would it have been an asset or a liability? So would it have been an asset or a liability? So if the carrying amount is more than the tax base, that is a
Liability.
Liability.
yes. Now let's look at the correct balances. Now, in terms of the correct balances, what would have been the correct carrying amount had you had taken into account the 10,000?
90,000.
Would have been 90,000. Are we all on the same page that the correct amount would have been 90,000 had we taken into account?
Please explain it again, sir.
So yes. So you remember, so we now calculating the deferred tax calculation, the implications of this. Mistakenly, there was an error where 10,000 was not taken into account. In other words, the carrying amount of the asset would have been 90,000 had it been depreciated by 10,000. Do you agree with me?
Oh, I see, sir. All right, thank you.
Okay. Now, we want to see the implications of that on our calculations of the deferred tax. Now, we know that the tax base was correctly taken into account as 96,000. But now, what is the difference, the huge difference between 90,000 and 96,000?
6,000.
It's 6,000. Now, what is 6,000 multiplied by 30%?
Isn't it like 1,800?
It is
Just did it in my head.
1,800. Now, if the tax base is more than the carrying amount, what is it? Is it an asset or a liability?
The asset.
It is an asset. Remember, when our carrying amount was more than the tax base, it was a liability. Now, the inverse is true. When our tax base is more than the carrying amount, then it is an asset, sorry, but it was a liability when our tax base was less than the carrying amount. And now, what is the difference? The difference is also what has to be corrected. So the difference is the correction.
So,
Hello?
and 6,000 was not supposed to be in bracket.
Oh, no, that is 100% true. Sorry, because it is an asset, right? Now, this is the correction required. So what is then the correction required? What is the difference?
600.
No, think about it again, because you just corrected me, and I think it's crucial.
3,000, sir. 3,000.
Do you understand why it's 3,000?
Explain it, sir.
So remember this, the difference between, we had 96,000 because of this error. Now the difference between 100,000 and 96,000 was 4,000, isn't it? Caused by this error. And then it resulted into a liability. So this is negative, right? So suppose the difference, it resulted into a liability that was nil. So let's say whatever we calculated here, we had made an error that resulted into a carrying amount being 0. It would have been 0. I mean, it would have been 96 and 96, and then we'd have had 0 here. And let's say now we had a correction of this balance where it's 90, 96, it would have been 1,800. Now the difference between the two would have been 1,800. You understand what I mean? Because you are not looking at the difference between 1,200 and 1,800. Rather, you are looking at the difference between negative 1,200 and positive 1,800.
Thank you, sir.
Do you get it now?
Yeah, I get it, sir.
You get the difference. So the difference then is, sorry, 3,000. And now if the difference is 3,000, can you suggest to me the type of journals that we ought to process for the correction of this error as far as the tax effect is concerned? Because deferred tax now is an asset, we're going to have a debit of deferred tax.
So I can please repeat it. 3,000.
Okay, let me just write the journal of 3,000. So let's start from here. Remember, on your incorrect journal, what would you have done? You would have you would have ended up with a liability of deferred tax of 1,200. Are you with me?
Yes.
So in other words, you would have had credit deferred tax liability by 1,200, and you'd have had the income tax expense debited by 1,200, right? In other words, you would have, when you're disclosing the income, so currently the income tax would have included that 1,200, right?
Yes.
Due to the deferred tax. Now you have a deferred tax asset, and the deferred tax asset emerged because you did a correction of balances, and now you have 90,000 and 96,000, which ultimately made a difference of 6,000, and the deferred tax was 1,800. And now the difference between those two was 3,000. Now you are recognizing now the impact of the correction of this error. So now, because your deferred tax asset is the one that is affected by this transaction, you're going to now debit 3,000 of deferred tax asset, right? And then you are going to what? Credit income tax expense by the same amount. So you credit income tax by 3,000, right? And now for the guys who wrote questions on the chat box, before now I move to the second category, can you please just read out your questions? Or maybe. Oh, no. Someone, Spamanda was making a joke saying estimated revenue. When some Kelo asked, where did we get the 200,000? All right. I think I think that could, okay, there was no serious question. I think there were just commentary. So let's lower that. Okay, I'm going to stop sharing the screen for now. And then let's take just briefly a 7 minutes break. And then we're going to start with the other categories. The second category is quite brief. And then we'll hit the third category where I want us to focus a little bit. So let me stop sharing. Okay, so the last time we were dealing with a situation where, the prior period errors were immaterial. Now, I mean, the prior period errors occurred in the current period. Now we're dealing with category 2, and I'm going to be a little bit quicker because I want us to get into category 3. Now, category 2 is that the prior period error are immaterial. So an error could be an omission in the financial statement or just a pure misstatement where it was deliberate. So it also could be one or more periods arising from the failure to use or misuse of reliable information that was available when those prior period financial statements were authorized or issued, and could be reasonably expected to have been obtained and taken into account in preparation of the financial statement. So it arises where there was misuse or failure to use. So misuse, which means a misstatement, a failure to use, it means an omission of information that was there in the prior period, but it was never used. But now, the prior period error, if it is immaterial, it must be accounted for in the current year. So first of all, this prior period error is discovered in the current year, but it relates to the prior period. So this is not covered by IAS8, but we're going to demonstrate how it is accounted for. Now, in your textbook, there is in page 1219, there is an example 8. Now, an example 8 is indicating the treatment and the adjustment of an immaterial prior period error. What I'm going to show is the journals quickly, and we're going to go through a similar tax calculation for the for this error, similar like the one we did on the previous example. Now, in the case of this, is that we had a vehicle that was purchased for 100,000 on 1 January 2018. Now, the depreciation on the vehicle was 10,000, and it was recorded as 10,000 instead of being recorded as 25,000. Now, as an indication that you are all back in class, what is the value of the error there?
We understated the depreciation by 15,000.
Yes, we understated the depreciation by 15,000. In other words, 15,000 worth of depreciation was omitted, right? Then if we underestimated depreciation by 15,000, what would be the correct journal then? What would we debit and what would we credit?
Debit depreciation by 15,000 and credit accumulated depreciation by 15,000.
Do we agree with him that we debit depreciation expense by 15,000? And then accumulated. Please write the full account on your test. by 15,000. So what is the correct narration? Well, it's a correction of a journal dated 2018. But in terms of tax, because we need to prove that our current tax is not affected, but our deferred tax is affected. And now how much is our deferred tax affected by? So essentially, what is 15,000 multiplied by 30%?
4,500.
4,500. 4,500. We all understand this. And you would have to apply the same proof that we did on the previous question, right? But in order for us to be efficient with time, because I want us to get into category 3, you will see on your textbook, apply the same principles that we applied on the previous question, because I want us to spend time doing question 9. Are we all on the same page? Can I get a yes? A very loud yes.
Yes.
Okay. I'm hearing the same people. Now, let's now start dealing with what affects our accounting standard for today. Now, we want to deal with prior period errors that are material. So what would that mean if someone can sponsor me with their opinion when we say that something is material? What are the implications of something that is material? And what do you think something material is?
Something material, it means that if it was available at that time, it would have make a big difference in the decision of the users of financial statement.
It would have made a difference. So very close. Who can help him with? What do financial statements often do? They influence the users, right? How do they influence the users? Can someone tell me, how do financial statements influence the users?
They provide information of the financial situation of the company. So it allows users to use the financial statements to make fundamental analysis to determine whether or not they want to make the investments in the company.
Yes, 100%. Let's say now I'm a banker. How would your financial statements, let's say these were your financial statements, influence me?
For instance, now if you're a banker, obviously then the business would most likely approach you because they want to lend you money. So as a bank, you would want to see their credit rating. What are their liabilities? To what extent do they use liabilities? And those times they use it, how often do they pay off those liabilities?
So for instance, exactly. So let's say, let me make an example. Let's say you give me a set of financial statements, and let's say the first example that we did was material. Now, it made the profit of the company looks more by 10,000, didn't it? Because I did not deduct an expense I was supposed to have deducted, right? So which means I would have thought that the company is more profitable than it is, isn't it?
Of course.
So it would have influenced me to make perhaps a decision. But if it's immaterial, which means it is not going to influence my decisions as the users of the financial statement. So something is material when it can influence the decisions of the users of financial statements, right? Now, materiality is something that can be both a quantitative figure or a qualitative figure as well. Why would, in which case where materiality could still be material, an item could still be material, even if the number is very small? Well, let me tell you, in instances where, for instance, the omission is a misstatement deliberately done by management. So if management steals any form of resources from the company, whether it doesn't, it's not quantitatively material, because the quantitative material figure is based on what the preparers of the financial statement determine to be material. So if they say, when we are preparing our financial statement as a company, any figure above 50,000 is material, right? Let's say under expenses or under revenue. So which means anything below 50,000, whether individual or added up, it won't be regarded as material. But assume that though the figure is below 50,000, it's as a result of theft by management. Would you make a decision then as a banker to finance a company where management takes some resources, steal some resources from the company?
No.
You wouldn't, right? So then that becomes a qualitative materiality instead of quantitative, because of the fact that it's driven by management. I wanted to explain that. So materiality is about influencing the users of financial statement. Now we're dealing with an item and an error that is material. And if an error is material, then it is covered by IAS8, the standard. Now, corrections made to a particular period in which the error is made. So in other words, you have to go to the period where the error is made and make that correction. So you discover an error this year, but it was an error that occurred last year or in the previous, in the year before last year. You correct those financial statements. So it is a retrospective restatement. It is a retrospective restatement. Now, tell me, in what elements within the financial statements do you think this kind of error would impact? Where do we report in our financial statements the profitability or lack of profitability of the previous years?
Statement of comprehensive income.
So the statement of comprehensive income, interestingly that you mentioned it, shows profitability for the current year. Now, in your same line of thought, once you've calculated your profit before tax, what do you deduct on your profit before tax? What do you calculate? Taxation, right?
Yes.
Now, once you deduct taxation, what do you have as the last figure there?
You got your retained earnings for the year.
Okay, before you get your retained earnings, you get your profit?
Oh, you mean net profit after tax?
Yes.
Okay.
And then where do you take it, that profit after tax?
You take it to your equity.
To your retained earnings, right?
Yeah. The equity.
In other words, now I'm still with your line of thoughts. Last year's changes in income, whether profitability or loss, where are they reflected in our financial statements in the current year? They are reflected in which opening balance? So anything that happened in the previous period in our income statements for those periods, it's reflected on the opening balance of our retained earnings. You agree with me?
Yes, sir, we agree with you.
So there is a movement from once. In other words, if ever there was something incorrect in those previous periods, what balance would be incorrect in our financial statements?
Opening balance of retained earnings.
So the opening balance of the retained earnings, if ever there is something incorrect in our previous period, the opening balance of the retained earnings would be incorrect. We all agree, ne?
Yes, we agree, sir.
So we agree. So I wanted to emphasize that point, why when we are adjusting a prior period error, you're going to see a lot of the utilization of the opening balance of the retained earnings. It is because the opening balance of the retained earnings is sort of an index, a summary of the previous year's activities that affected the previous year's income statements. So they are all summarized in the opening balance of the retained earnings. Now let's do example 9. From example 9, I want to see if someone has opened example 9 on page 1221. Can someone read that example 9 for us? Can someone assist us with example 9? Reading.
Example 9, correction of a material error that occurred in a prior period. Valentino Limited purchased a specialized machine on the 1/1/2027 for $1 million. Valentino Limited provides for depreciation on the diminishing balance method at 20%. The following relates to an error made by Valentino Limited. It processed depreciation of 200,000 in both 20X7 and 20X8 and 120,000 in 20X9. The error was only picked up in 20X9 after the current period's entries had been processed. The income tax rate is 30% and has been unchanged for many periods. The tax authorities allow the annual deduction of 20% of the cost of the asset. And the required is provide the correcting journal entries for the current year ended 31 December 20X9.
Okay, so what is the first thing that we have to do is that we need to calculate the correction that is required. Now, we're told exactly how much depreciation the company deducted, right? So we have 20X7, we have 20X8, we have 20X9. Now, this is depreciation that is incorrect, or let's say partially, because we may find that there's no difference, or the difference is the actual error that needs to be corrected. So that's what I'm trying to say. So they process 200,000 in 20X7 worth of depreciation. They process 200,000 worth of depreciation in 20X8, and then they process 120 in 20X9. But what I want to know from you is, what was the correct depreciation if the depreciation is on a diminishing balance method and the asset that was purchased is 1 million? What was the correct depreciation in 20X7?
200,000.
And how did the 200,000, how did you arrive at 200,000?
It's the million times the 0.2.
It is the million multiplied by
0.2.
why 0.2? Okay, you are right. 0.2, is it not the
It's the
same?
diminishing.
Is it not the same as 20% divided by 100?
It's the same.
It is the same. So it was the depreciation for the first year, it was 200,000. So is there a correction required for that year? Is there a correction required for this year? 20X7.
No, there isn't.
So there isn't a correction required for this year. We all agree. But now
Yes.
in 20X8, what would have been the correct depreciation?
160,000.
Why 160,000?
Because you take the million and subtract the prior depreciation before you multiply with 20%.
Do we all agree with him?
Yes, sir.
Because this is not a straight line method, rather it is a diminishing balance method. So it will be the 1 million less the previous year's depreciation, then multiplied by 20%. And that is 160. So we depreciated, therefore we reflected a depreciation that was more than we're supposed to have process. Now, what is the difference?
40,000.
It is how much? The difference between the correct and the incorrect depreciation.
40,000.
40,000.
It is 40,000. So that is the difference. It is 40,000. Now, what is this 40,000? Is it a liability or is it an asset?
It's a liability.
Why do you say it's a liability? Okay, so let's make another example. What would have been the impact of in the future of having more depreciation?
No, I think I'm wrong if I say it's an asset. If we had more depreciation, then the actual depreciation then would have an asset because we would have depreciated more than what we were supposed to.
In the future, if we had more depreciation, it would have been an asset, right?
Yes.
But now, if we had depreciated more the current year, what would have been the impact? So imagine the situation. If now they had depreciated less in that current year, what would have been the impact?
Impact on what?
On the
It would
deferred tax. So the more the depreciation, let's say the more the depreciation that you are recognizing in your financial statement, what is the other side? You've got a deferred tax what?
Then if they depreciated with more amount, I think we have a liability because that means we had lesser profit and then we were taxed on lesser profit compared to the
No,
actual
remember,
profit.
so SARS have their own way of calculating. So we're saying, in our view, our depreciation for this asset based on this method is supposed to be 200,000. That's what we're saying. But SARS obviously have their own way of calculating. But now, if ever now we are changing that to the correct to the correct policy, that it is 600,000. So instead of having 200,000, we have 160,000. So our depreciation has decreased by 40,000, right? So the decrease in that by 40,000 of our depreciation then would have been a what when we're adjusting it in the current year. The correction of error that is made on the previous years would then result in a deferred tax liability. In other words, the 8,000, which is the 30% of this correction of error, as we're adjusting it, it would be a liability. And wait for me just now. Let's finish the 2020X9 correction, and then I will do a journal that will clarify what I'm saying to you just now. What would have been the depreciation now, the correct depreciation for 20X9? So first of all, you say 1 million minus 200,000, you get 800,000. Now 800,000 minus 160,000 is how much? $800,000 minus 160,000.
640.
640. And what is 640 times 20 divided by 100?
128,000.
It is 128,000. Now, what is the difference between the depreciation recognized and the depreciation now that was supposed to have been recognized?
8,000.
8,000. So we recognize less than we're supposed to recognize, right? Now, if we recognize less than we're supposed to recognize, did we essentially get a tax benefit? So notionally, we're supposed to recognize 128,000, and we know the impact of an expense on our profit before tax is that an expense reduces our profit before tax, essentially reducing the amount that is supposed to be taxed by the revenue. Now, in that case, then the difference would be an asset because it is less than what we recognized, right? Previously, we recognized more than we're supposed to recognize. And now we need to do our journals based on the information that we have above. I wouldn't like to delete the information above because I think it's going to help us as we process our journals, debit and credit. Now, we need to make 2 journals, and the 2 journals must show how we account for a correction of error made in the prior period. And what is our prior period? So if ever hello, are we all back? Hi, everyone, are we all back?
Yes.
Okay, I'm not 100% sure why I dropped out. Okay, can you mute if you're not interacting with the class? So you can only switch on your microphone when we are engaging with the course content. So we're currently going to develop journals based on the scenario that we've just done. Now, what we wanted to determine was what do we debit and what do we credit? And the first thing that we said was we will do journals for our prior periods and as well as our current period. Now, the question that I posed was that if we've got a December 20X9 financial year end, which year end is our prior period? Would you please mute? All right. Sorry, there is a participant that is supposed to mute. Would you kindly mute, please? All right, so there was no error in 20X9. So there is no prior period, I mean in 20X7. In other words, there's no prior period adjustment that should be made because both the depreciation that was recorded in that year and the correction were 200,000. Where we had an error was 20X8. 20X8 had an error of 40,000. We all agree, right?
Yes.
So if 20X had an error of 40, because a depreciation of 40,000 had been included in that year, which should have not been included. Now, what is the correct debit balance that we should use to adjust the 40,000? Now, the thinking process we have to go through is when we recognized depreciation, what was our credit and what was our debit? Can someone tell me, when you depreciate an asset, what is your debit and credit in your journal entry?
Depreciation is debited and accumulated is credited.
Now, so which means when you are doing a correction of error that is material, always think of the first journal. What was the initial journal that I did? I debited depreciation, credited accumulated depreciation. Now, in order for us to reverse the impact of that journal that we processed, what should we currently debit? And essentially, it's supposed to be the element that we had credited. What had we credited? We had credited accumulated depreciation. You agree with me now, to reverse the impact of that, we must debit accumulated depreciation. You all agree with this? Do we all agree with the fact that 40,000 of accumulated depreciation I need to debit because I credited it?
Of course, sir.
All right, so we all understand it. But in this journal, what should I now credit? I want to see if now you're going to apply your mind and thinking what gets affected.
I think would be the asset, because we decrease the asset with more amount than we're supposed to be decreasing it.
Before I answer you, can someone else, one of your peers, interrogate what you're saying? Can someone participate? He's saying we should credit asset. Who else has a different view?
Sir, can I take a shot at it?
Yes.
Since originally what we had done, we had originally debited depreciation expense. But the thing is, we don't normally reverse expenses in accounting. So what I think we would do is like we would credit a reversal thing. So maybe that account would be called credits 40,000 reversal of depreciation, and it'll be like a separate line item. If you get what I'm saying, maybe not a separate line item, but you understand what I'm trying to say.
So I understand exactly
like an
now
income
what you guys are saying. Let me first start with him. You saying we should debit and we should credit an asset, Menier, right?
Yeah.
First gentleman, I cannot see your names now. The first gentleman said we should credit an asset, right?
Yeah.
But let's think about this. What did we do that affected the asset in that prior period? We had depreciated that asset. And how then did our balance sheet got affected by that depreciation? It got affected by what? An account by accumulated depreciation, right?
Yeah.
But how did accumulated depreciation affect that account? It reduced that account on the credit side by 40,000 more. Do we all agree with that?
Yes.
Oh yeah. Yes. No, I think it's a.
So yes, before you come through, we had adjusted it by 40,000, but now we then reverse that impact in this correction journal by debiting the 40,000 of the machine, because that machine should have not been reduced by 40,000. Are you with me?
Yes, yes.
So the impact of what you are saying now has been already corrected with this journal, because remember, it was a credit error. Now we reversed it by debiting. Now coming to the second gentleman, the second gentleman is saying there is a complication with the expense. But I'm saying, let's go back to the process that led us into this situation. Where did we record this expense, this 40,000 more? So let me take you through this process. So this 40,000 more, where did we record it?
On the
Statement of comprehensive.
On the comprehensive income. So by recording 40,000 more on the comprehensive income, on our statement of comprehensive income, what impact did it have on the profit before tax?
It decreased.
It decreased our profit before tax, isn't it?
Yeah.
Yeah.
So our profit before tax decreased by 40,000, right? Because we had recorded that taxation, right? I mean, sorry, that expense. Are you with me? So in other words, we took.
Yes, we're with you.
We took a lesser amount to our retained earnings. Are you with me?
Yes.
Yes.
So let's just deal with one dimension. Let's assume there is no tax involved. We took 40,000 less of a profit to our retained earnings. Is that not clear?
Yes, it's clear.
What does it say then about our retained earnings opening balance in the current year?
It's smaller than it should be.
By 40,000, right? We're assuming that there's no tax. So then do we agree with, if a retained earnings is smaller by 40,000, to correct it again, to push it back to be what it is, where would we adjust the 40,000?
On retained earnings.
On retained earnings, but on which side? On the debit or on the credit? In other words, where does an income increase?
On the credit side.
On the credit side.
So which means our retained earnings as a result of adjusting an understatement of an expense would necessarily increase, right?
Yes.
But the second aspect of it, another dimension, is that what is unique about retained earnings? What kind of a profit you take to retained earnings? It's a profit net of what? Net
Of tax.
So our profit before tax was supposed to be more by 40,000, but then we have to remove the tax element, the tax effect of that 40,000. How much is that?
12,000.
It is 12,000. So our deferred taxation should be credited by 12,000. Now, if we're crediting deferred taxation by 12,000, what is it? Is it an asset or a liability when it's credited?
Liability.
Liability.
So which means we have on our journal 12,000. Then what should we be having on our retained earnings?
28,000.
28,000. Now, Jens, because you've engaged this question, can you explain to me again? I just want to get an understanding that you properly understand this journal. What did we just do on that journal, and what were the reasons we processed that journal the way we did?
We debited the accumulated depreciation because we decreased the assets with 40,000 more, so we had to correct that. Then the second part, we credited the same earnings because we recognized lesser profits that was less by 28,000. Then we have to recognize 28,000 again, and then we debit deferred tax because we recognized lesser profit previously, which is 12,000.
Guys, does it make sense why this journal is written this way? The fact that it's a prior period error, so the prior period error affects our retained earnings because all the changes in a certain year get reflected on the income statement. But ultimately, the product of the income statement, the final product, gets reflected on the retained earnings. So that is why our prior period error would necessarily be reflected on the retained earnings and the affected accounts. Hence, we've got a debit now of accumulated depreciation. Now, depending on the reason why we see a credit in this instance in our retained earnings, it's because there was an understatement of the profits. And also, we've taken into account the taxation impact. We're not going to study disclosure today. We're just studying the processing of the journal. So this is how we process the prior period journal. So it's a correction of a journal made in the prior period. Now we need to also process the journal that has been, the error that has been made in the current period. And how do we do that? The error that has been made in the current period. So the error in the current period is similar to the examples that we just performed. So the error in the current period is that there has been an understatement of depreciation by 8,000. But remember, because it's the current period, what is it going to affect? Our retained earnings or our statement of comprehensive income? Hello?
Comprehensive income.
Our statement of comprehensive income. So what will be our journals? Let me remove these ones now. It will be debit depreciation, right? Of 8,000. And what do we credit? What do we credit?
accumulated depreciation.
For the machine, right? The accumulated depreciation, and accumulated depreciation has a credit balance on the assets by 8,000. So on our narration, that is a correction of error made in the current year, but this 8,000, what is its deferred tax implication? What is 8,000 multiplied by 30?
Isn't it like 2,400?
It is 2,400.
Sweet.
Hello?
No, I just said sweet.
Oh. So we've got deferred tax. And now what do we put there? Is it a deferred tax asset or liability?
It's an asset, sir. because we are. That means
why
that
I'm
our
laughing?
profit
You know why I'm
decreases. If our
laughing?
profit decreases, that means what?
Essentially, okay, it would have been a deferred tax asset, all right? It is a deferred tax asset, but then we are correcting an error. So what are we correcting an error? We had recognized this 8,000 as what? Essentially a liability, and we're reversing that.
Yeah.
So that is why now we put an L, because we are reversing what we initially recognized mistakenly as a liability.
Let's just put deferred tax would be still get marks.
So journals, it's difficult to award marks if ever you're not going to indicate whether it's an asset or a liability. Because here now you're demonstrating to me that you understand what you are reversing. So then it's a correction, when you narrate this one, it's a correction of error in the current year. Now what I want to do is to stop sharing. Guys, stop sharing now. Have I stopped sharing? Hi guys, have I stopped sharing?
Yes, sir.
All right, okay. And now also I'm going to stop the recording.